Welcome back. I'm Hugh Johnson, the chairman of Hugh Johnson Advisors, and periodically, of course, we get together and talk about what's going on in the economy and the financial markets, give you a little bit of a sense of what we're doing with portfolios in what's always been a difficult financial market and economic environment. It's always very tricky, often difficult to figure out what to do. But I think the important thing that we've learned certainly from the last week or two where we had a sharp decline in stock prices. I think it's important for individual investors as well as professional investors such as ourselves not to get caught up in the news of the day, so to speak, and some of that, of course, is intensely political. It does create some very significant declines, sometimes advances, but most often declines in stock prices, and that it's only temporary. And it's very important to realize that there's some things in the world of finance as well as economics that count, and a lot of stuff that's what we call surface noise that does not count. It does create significant volatility. It's important to understand what counts and what does not count. And when it does not count, as a lot of what you see coming across the tape, so to speak, to use the vernacular, when it does not count, it's important to ignore that and not to get caught up or to make portfolio changes in response to those volatile creating events. That's one thing we've learned for the last couple of weeks. We've learned a lot of other things. Things are moving along here. The most important question, of course, which I continue to get asked, a lot of folks are questioning it, puzzled by it, is that this has been, of course, a very long cycle, a long stock market, economic, interest rate cycle. Now the second longest stock market cycle in the post-war period, post-World War II period. And the question is, how can you make the case that it's going to continue, or is it going to continue? Are we near the end of the current cycle? And the answer is, when you look at the performance of the financial markets collectively, and you look at the performance of important monetary and economic variables also, you find that the two are telling you that we have further to go in the current cycle. We don't know how far it has to go, but those numbers, those financial market numbers, those economic numbers tell us we have further to go. You know, there was a survey done by Bloomberg News very recently, a survey of 30 economists asking them, when is the current cycle going to end? And the consensus was that it's not going to be until the latter part of 2018 and 2019, and that certainly is in agreement with what we're seeing or looking at when we look at the performance of the stock market, the bond market, a lot of the variables within those markets, and of course important economic variables such as the index of leading economic indicators, which tells us where the economy is going, and those leading indicators continue to improve or point to an expanding economy. So that's where we are. The big news of the day, or the news that is now sort of gaining the attention of Wall Street, or the focus of many professional investors, is news about the Trump tax reduction and spending increase, infrastructure spending package, this economic package. There's growing optimism about it, and I think it's well-founded optimism. There's a group of 6 people in Washington, starting with Secretary Cohn of the Trump administration, as well as Mnuchin, Secretary of the Treasury Mnuchin, along with various congressional leaders such as Brady and Ryan from the House of Representatives, Mitch McConnell and Orrin Hatch from the U.S. Senate, who've been working behind closed doors for a period of 6 months, trying to cobble together, to put together a tax package, a package which includes tax reductions for corporations, tax reductions for companies that are not corporations, we'll call them C corporations, limited liability companies would be an example, and it also includes tax cuts for individuals, particularly middle-income taxpayers. There's a lot more to this tax package. And the other part of this, of course, is when you do have tax reduction, for example, corporate tax reduction from, say, 35%, its current level, down to, it looks like we'll be talking 22 to 26%. That's going to create a revenue problem for the federal government. It's going to reduce revenues and increase deficits. So there's been a lot of work that's being done on trying to find revenue offsets, revenue raisers, ways to offset the loss of revenues. And they're coming up with a real strong package. Corporations may not be allowed or enabled to reduce or to deduct the interest that they pay on their debt. It may be the case that we'll see some of the deductions that individuals pay. They're talking a lot about the elimination of the deductibility of state and local taxes, which will be very controversial in high tax states such as Massachusetts, California, certainly New York. So that's going to be very controversial. But there'll be a lot of deductions that individuals currently take that they will not be allowed. But the offset, of course, is that the tax rates themselves, both for individuals, tax rates for corporations, will be reduced. One thing they're talking very, very actively about is the repatriation of that cash that's in the accounts of corporations in other parts of the world, as much as $2.4 trillion, trying to find a way to repatriate that money back to the U.S., and hopefully it'll be invested in very productive ways in the U.S., trying to find a way to sort of unleash that return or repatriation of that money. That'll be a big part of what we see. But the most important thing I want to say is it looks as though they're making real progress towards that. Why is that important? It's important because right now the stock market, yes, we have further to go in the stock market business interest rate cycle, but the stock market seems to have stalled out since early March. Haven't made much progress. And the reason we haven't made much progress is a lot of professional investors have become very concerned about valuation. I've said that many times over. They're concerned about that the upside potential for the stock market from current levels might be positive, but not very positive. It's not much upside potential, or we're fully valued. And that certainly is true if we accept our economic forecast, which is in the low 2 to 2.2%, which implies a level of earnings which is not particularly strong. That's not particularly good news. We need better earnings. How are you going to get those earnings? Well, if you get a tax cut from the Trump administration, a reduction in the corporate tax rate from 35 down to, say, 24%, 25%, 22%, that could enable a much stronger growth in earnings, the kind of growth in earnings or levels of earnings that would justify stocks at current levels and maybe even higher. And the other thing is that the consensus among a lot of analysts is that S&P 500 profits are going to be much higher than we are currently expecting. If they are much higher than we're currently expecting, that also would help legitimize or justify the current level of stock prices and even a higher level of stock prices. This is all about earnings, and you can make the case that earnings are going to be better than we're currently forecasting. The point is the market has stalled out a little bit. We're playing it a little bit on the careful side right now. We're not adding to positions at current levels. If the market breaks from current levels, we might add to positions. But right now, because of our concerns about valuation, we're a little bit concerned. But there are ways out, and we'll just have to develop our view as we go through time. The most important thing is that, as I said before, don't get caught up in those day-to-day, week-to-week swings in the financial markets that may be triggered by political events. That's wrong to get caught up in that. It's wrong for us to get caught up in that. That's why we've developed the disciplines to deal with it. And the second thing is that there's further to go in the current stock market business interest rate cycle. And the third thing is that there are concerns about valuation, but those concerns, again, can be mitigated. If we do get a Trump tax cut, prospects look better today than they've looked for some time. Or, on the other hand, if the consensus forecast for earnings among analysts proves to be right and we prove to be a little bit wrong, that of course would help tremendously. Right now we're fine, but we're obviously watching very carefully. We, as always, are watching carefully, using our disciplines to analyze the current situation, make sure we make the right changes in portfolios, and we certainly appreciate the confidence that you've shown in us, in the way we're managing portfolios, the results we've achieved, and we appreciate that ongoing confidence. If ever a question comes into your mind, a concern, a thought or two about what's going on in this world of ours, we want your views, we want your questions, and please feel free to call any one of us on the Hugh Johnson Advisors team. Again, thanks for your confidence, and I look forward to talking to you again in maybe a little less than a month, maybe a little more than a month, but in about a month's time. Thanks again.